You've heard all the promises, right? Build a portfolio that pays you while you sleep. Let dividends cover your bills, maybe even retire early. It sounds incredible, but there's always that one big question that seems to get glossed over. How much money do you actually need to even get started? Well, today, we're going to pull back the curtain on all of that. We are going to demystify dividend investing and show you exactly how it can work for anyone. You know, for most of us, when we hear stories about investing, it feels like it's a club we're not invited to. This idea that you need tens of thousands of dollars just to sit at the table, it makes the whole concept of passive income feel like this impossible dream. And that gap, that space between where you are and where you want to be, is exactly what keeps so many people from ever starting at all. But what if I told you that you didn't need a huge pile of cash? What if that barrier to entry was way, way lower than you've been led to believe? In this explainer, we are going to lay out a super clear, actionable plan to start building real wealth with just $500. That's it. So let's jump right in. Okay, before we even think about growing your money, we've got to talk about the invisible force that's actively shrinking it every single day. There's a silent thief at work in your wallet, and its name is inflation. This chart tells the whole story, doesn't it? For years, inflation was pretty tame, just humming along at about 2%, but then, bam, in 2021, it just exploded to over 9%. That's the highest it had been in 4 decades. And yeah, it settled down some, but that thief is still creeping around, making every dollar you have worth just a little bit less every single year. And here's where it really hits home. Your money's buying power is actually shrinking faster than your paycheck is growing. So while the average household income went up by about 1.3% last year, inflation was closer to 4%. So on paper, you got a raise, but in real life, you're actually falling behind. Let's make that real. A 3% inflation rate doesn't sound like much, right? But it means if your weekly grocery run was about $150, you're now paying an extra $230 over a year for the exact same food. Now imagine that applying to your rent, your gas, your bills. You get the picture. And that is why simply saving money in a bank account isn't going to cut it anymore. To actually get ahead, your money has to be growing faster than inflation is eating it. And that brings us to the solution and your $500 starting line. I know what you're thinking. $500? Really? Is that even worth the effort? So many people put off investing for years, waiting until they have thousands saved up because they think a small amount won't make a difference. But honestly, that's just old school thinking. So here are the 3 big reasons why starting small actually works today. First, something called fractional shares. You don't need thousands of dollars to buy a share of a big tech company anymore. You can buy a $50 slice and get the exact same percentage returns. Second, time is your absolute biggest advantage. The more time your money has to work for you, the more powerful it becomes. And third, opportunity cost. I mean, think about it. That $500 could be a new phone that starts losing value the second you open the box, or it could be an asset that grows and pays you for the rest of your life. So how does a small amount of money actually turn into something significant? It's not magic. It's a powerful financial engine called compounding, and dividend investing puts that engine into overdrive. We like to call it the snowball effect. So how does this snowball even start to roll? It all begins with something called a dividend, and a dividend is simply a cash payment a company sends you just for being a part owner of the business. When the company makes a profit, it shares a little piece of that with you. It's basically a thank you for investing in them. And the best part is, you get that cash without having to sell a single one of your shares. But just collecting those small payments isn't where the real power is. The secret sauce, the thing that turns a small investment into a massive one over time, is a strategy called DRIP. That stands for Dividend Reinvestment Plan. And this cycle right here is pure genius. You earn those dividends, but instead of taking the cash, you automatically use it to buy more shares of that same company. Now, those new shares you just bought, they start earning their own dividends, which then buy even more shares. You see, it's this beautiful self-perpetuating cycle. It starts out small, like a tiny snowball at the top of a hill, but over time, it builds incredible momentum. Of course, none of this works if you're investing in the wrong companies. You can't just throw your money at any stock that pays a dividend and hope for the best. The key is knowing how to filter out the risky ones from the rock-solid ones, which is exactly what we're going to do next. We're looking for 5 key signs of a quality company. Think of it as a checklist. First, a healthy dividend yield, which is just the annual dividend divided by the stock's price. The sweet spot is usually 2 to 5%. Second, we want dividend growth. We want companies that consistently give us a raise. Third, share price appreciation. The stock itself should be growing in value over time. Fourth, business durability. Just ask yourself, is this a company people are still going to need in 20 years? And finally, resilience. Has it proven it can keep paying those dividends even when the economy gets rough? Okay, so what does that look like in the real world? Here's a sample portfolio for a beginner with 5 holdings that check all those boxes. We've got SCHD for broad diversification, Morgan Stanley for its incredible dividend growth, AGM in the super stable agriculture sector, CubeSmart in self-storage, and Interparfums, a really strong global beauty company. Now, when you put these 5 together in an equal weight portfolio, you get some really powerful numbers. We've got an average starting yield of about 3.5%. But check this out, an average dividend growth rate of over 18% per year. That is huge. And on top of that, an average share price growth of over 12%. This combination, this is the engine that's going to drive our snowball. All right, now for the part you've been waiting for, the big question. What actually happens when you put your $500 into a portfolio like this and just let that engine run for 10, 20, or even 30 years? Let's run the numbers. But before we look at the final numbers, I want you to burn this idea into your brain. Compounding is a game of patience. It feels incredibly slow at first, almost like nothing is happening. But over a long period of time, the results become truly explosive. So let's start with our first scenario. You invest your $500 into the sample portfolio, you turn on that dividend reinvestment plan, the DRIP, and then you don't add another penny. You just let it do its thing. Okay, after 10 years, that $500 grows to about $2,400. Not bad. After 20 years, it climbs to nearly $16,000. Okay, now we're talking. But look at year 30. This is where it gets insane. That initial $500 investment would be worth around $174,000, and it would be paying you almost $24,000 a year. That's $2,000 every single month in passive income. That is absolutely incredible on its own. But this is where it gets really, really exciting. What if you just gave that snowball a tiny little push along the way? What if on top of that initial $500, you contributed just $2 a week? I mean, that's less than a cup of coffee. The difference is, honestly, it's staggering. That tiny habit of adding just $2 a week more then doubles the final outcome. The portfolio's value skyrockets to a projected $373,000. And the passive income? It would be generating nearly $52,000 a year. That's over $4,300 coming in every single month. Think about that. From a one-time investment of $500 and the cost of a weekly coffee, you can build a legitimate, serious income stream. The numbers are real, the strategy is straightforward, and the opportunity is there for everyone. Your financial story starts right now. So the only question left is, what's your first step going to be?